This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name, as always, is Alex Perny, and today we are very pleased to welcome on Brian Seidensticker, the founder of Tax Sale Resources and Mount North Capital. And one thing that people often ask when getting invested in real estate, and something throughout the course of my career that I've run across, quite often, you got to start somewhere. And often people kind of gravitate towards things that just inherently cost less money. Precious few people in the world start out with $1 million of capital just to go out and start buying real estate with. You have to start somewhere. And typically those are going to be things like wholesaling contracts, different types of different things that you can do with maybe small loans. But something that people often kind of land on is tax deeds and tax certificates, simply for the point that you can get into the real estate realm. You can potentially get into owning and controlling real estate through these vehicles for significantly less money than going out and buying a property outright. And some of the most lucrative deal I've ever seen in my career, which I'll give the story on a little bit later on the podcast, was through a tax deed purchased up in DeKalb County, Georgia. So it's a fun story. Certainly not everything works out that well, but it's something that people kind of, gravitate towards because of that easier barrier to entry from a capital perspective. But understanding these things and how to kind of go about doing them can be relatively cumbersome for the simple fact that there are so many different ways that you can go about buying them. In almost every single county in the United States, there's a different way that they issue tax deeds and certificates. Again, whether it's a deed state, whether it's a certificate state, how the actual bidding and auctions work, how you actually have to pay for these things, what you can do to, claim income against them and how they convert. It's a lot to digest and it's a lot to take in. Conceptually, they're easy enough to understand, right? But going forward and actually, purchasing these things and making money off of them, there's people that make whole careers on just going out and educating on these things. Quite a few, and I've actually interviewed a few on this podcast as well. So that's kind of what we like to focus on today, is that segment and kind of how it's changing and what people like Brian are doing to help try to bring some additional light and ease of use to this marketplace, because it certainly is something, in my experience with investing with clients is cumbersome is maybe putting it mildly with some of these things. So Brian, really appreciate you taking some time out of your day to come chat with us. If you wouldn't mind, give us a little bit of background about yourself. I don't think that they offer, if they don't offer college degrees in tax certificate investing. So, kind of how'd you come to be in your current franchise?
Yeah, well, thanks, Alex. Thanks for having me on. Excited to be here. I gotta hand it to you real quick, because rarely am I on a podcast where the host actually understands any facet of tax liens, and so I gotta hand it to you. I'm definitely interested to hear your story in Georgia. So this will be fun. You're right. There is no, at least I'm not aware of any major in tax lien investing. I still have yet to ever speak to a child that has aspirations of becoming or entering into the tax sale space. So
and if you find one, I guarantee you there might be a little bit of an odd kid.
Odd or I guess I talked to one gentleman who he said he was aware of it since a kid because his dad was in it, so second generation. But outside of that, I think they'd be Warren Buffett-esque, but odd, but not in a bad way, right?
Yeah, hey, make money out of it.
Yeah. Yes. Anyway, I guess I kind of got introduced to the whole concept really in the wrong way, if you want to look at it like that. I'm actually an aerospace engineer by trade and in my former life, and I was flipping houses kind of as a side gig, and we had one that we ended up getting upside down in the downturn in 2007 and 8, and it was in Montana, and Montana has some, you mentioned every state has different process, but Montana has some weird statutes where every potential investor in buying the tax lien on a property, they have to send a certified letter to the property owner. So I got not just a normal notice from the county like most states. I got dozens of certified letters from these different investors based different language, but basically saying the same thing. If you don't pay your property taxes, you could potentially lose, ownership of your home, and all that got me going. One, it was like, oh crap, I got to go take care of this, and did. Never lost the property to a tax sale, but definitely the fact that I gotten all these from all these different investment groups made me investigate what the heck this whole tax sale thing is about. Ended up finding out it's real. It's about a $9 billion-ish industry on an annual basis, and I was kind of floored by, I guess relative to real estate as a whole in the U.S., it's small, but it's not like it's a couple $100,000 space. It's a fairly decent size. And so anyway, that's a long story short how I got introduced to the whole thing.
Yeah, and again, it's, people kind of get introduced to this area from a lot of different perspectives. I think it's kind of two camps typically. It's people that, are investing in real estate for a long time, and maybe they just kind of, the osmotic effect, just kind of understand what happens. Or like, hey, they want to get in for, less money than it costs to buy a house and get into it. Or people like you that maybe have had some experience in there. So I think kind of a good place to start is understanding, again, what these are, because the terminology in the industry, in the ecosystem, right? People use the term tax deed and tax certificate almost interchangeably, and they are wholly different things. So maybe let's kind of start with what a tax certificate is, and then lead into like, hey, what a tax deed is, and just some, of the differentiation between them.
Yeah, and I guess so folks kind of know, hey, this guy might know what he's talking about. I am on the board of the National Tax Lien Association, and I'm one of, I think, less than 40 what they call certified tax lien professionals. It's not a designation. CTLP is not a designation that most people are aware of, like PhD or MD or anything like that, but do know a thing or two, I guess, is what it means at the end of the day. And what I think, Alex, what I found to really help is I'll just describe like how being delinquent on taxes, what that means, and then
I think that's a great place to start. That's kind of how I explain it to people too.
And it's you're exactly right. It's, states have different terminology, and so I'm gonna use the terms tax lien and tax deed, and some states, Louisiana is one where they use the term of a tax deed everywhere, but in the function, it's actually a tax lien certificate in Louisiana. So. Anyway, take the terminology with a little bit of grain of salt. We've standardized it, and so that we as a company can talk about the same thing when we're talking about tax liens in Louisiana versus Montana, etc. But as anybody goes to research their state, you'll definitely want to translate it to whatever the state local lingo is. So back to what the heck a tax lien is. So I think it's important to highlight. When people don't pay their property tax, nobody likes to pay taxes, right? But what do property taxes go towards, right? It's paying teachers, paving the roads, paying policemen, firemen, that sort of thing. And so when a county, right, doesn't if one person in the county doesn't pay their property taxes, it's probably not a real big impact. But there are counties where there's a significant number of folks that don't pay their property taxes on time, and it can add up to 10s, 20s. I think the largest sale is typically Cook County, Illinois, which is Chicago, and it can be over $100 million of basically a shortage on their budget. And so what the county is looking to do is balance their budget, right? It's like, hey, I'm $100 million short. They, for lack of a better word, make a deal with an investor, a third-party investor, and they say, hey, if you pay the amount that I was due now, let's say it's $1,000 in property taxes I was due, you pay that to me now, and then at some point in the future, when the property owner pays their property taxes, plus they're going to have to pay some sort of penalty and interest, right, for being late. That late fee is what you, investor, would get, when the property owner pays their taxes. Now, as collateral for that loan, I'm going to call it a microloan, I will issue you a tax lien, and that will be recorded against the property. And that gives you the ability to enforce that position if the property owner doesn't pay their property taxes for a long period of time. Now that what they're getting, the investor's getting, is what I'm going to call a tax lien, right? Tax certificates, there's different terminology. The key there is you're not buying the property. You're buying an interest in the property. It's usually at a few percent of the property value, whatever the tax rate is in that particular area. And you have no rights to the property while you own that certificate. But when, in most, vast majority, it's like 98, 99% of folks will eventually pay their property taxes. when they do, they issue that check to the county. The county turns around and says, hey, the lien is released, and here's your check plus interest, and that's how you investor makes their money on a tax lien certificate. So that's a much simplified version of what the heck a tax lien is. Now, kind of diving into what does that do for how does that compare to a tax deed? So essentially, what happens, again, each state is slightly different. There's been a lot of change to a recent Supreme Court case we can dive into, but more and more are adopting this exact model. But let's say the property owner continues to not pay their property taxes. Now, I like to compare it to mortgages, because it's very similar to how a mortgage works, right? Typically with a mortgage, if you don't pay your house payment for a couple months, right, that foreclosure starts immediately, right? Taxes are a little different. Usually it's at least 6 months. Many times it's multiple years, and sometimes it's 3 to 4, 5 years later. At some point, the tax lien holder will have the right to enforce that lien. And so just like a mortgage holder having the right to enforce, they can start a foreclosure process. And so that foreclosure process can be administrative, meaning the county is doing what they need to notify everybody, or it can be judicial, meaning the courts are proceeding through and notifying everybody. But both items both proceedings end in a sale of the property, right? That sale of the property is traditional in the form that I think most people can picture, right? You're in a room or online. It's like, hey, I'll bid 10,000, 20,000, 30,000, up to some percentage of value of the property. And that is selling the actual deed to the property. That's what we're going to call a tax deed. Again, terminology changes from one state to the next. But in that case, you don't just have interest in the property at that point. You're buying the property. Now, there's some states that, and you might speak to this about Georgia, some states kind of have this weird hybrid of you bought a deed and there's still a redemption period at the end of it, and you don't have full rights to the property until the end of that redemption period, and that's where it comes in each state, having its own process. But you as a tax deed holder, your intent typically in attending those auctions is you are going to own the property, and you're going to do something with that property, whether it's fix it up, rent it, fix it up, sell it, whatever it may be. You don't just earn an interest from the lien going unpaid for a period of time and then getting a check a year, or a day, a month, or a year, maybe 5 years later, like a tax lien is. So does that help, Alex, as far as
Yeah, no, absolutely. I think that's a very good delineation of kind of how those two things differ. Now, to go back to certificates a little bit, I think most people in real estate, if you're dipping your toes in, or even a seasoned investor, you have to understand debt, right? And there's a certain kind of pecking order and seniority, right? That's the technical term for it, to debt classes or lien classes, right? So when you hold a tax certificate or a tax lien, right, against a property, where does that kind of fall on the seniority of debts, right? Does it go before a mortgage to get paid? Does it go, is it subordinate to, let's say, like a mechanic's lien? Like, where in that kind of stack does that fall?
So it is governed by state, but you're exactly right. Most people think of mortgages like it's the primary mortgage, the secondary mortgage, right? It's, first has to get paid before the second gets anything in a foreclosure scenario. Tax liens in most states are what they call a super priority lien, meaning they're above just about everything else. They're a higher priority than a mortgage. With a couple exceptions, there's a sale type in Pennsylvania that it doesn't wipe out mortgages, and New Mexico. At least those are the two states that come to mind where you got to be a little careful. But in general, most tax lien auctions, the collateral that you have is ahead of the mortgage holder. And so in a scenario where there is a foreclosure taking place, many times if there's a mortgage on the house, the mortgage company will come and pay that lien off because they don't want to lose their position on that property, right? And so in theory, if the lien gets foreclosed on, right, it gets sells at auction, the mortgage is essentially, I'll say, wiped out. I think that's a very loose term that's used out there, but the mortgage holder's been notified. They have the right to come redeem it. The county is basically screaming to all the interested parties, somebody come pay these property taxes. And if not, then they're saying, okay, well, you all had your chance, and now your liens are extinguished because the tax lien has that priority.
Yeah, exactly. And that's something that, is not always necessarily recognized by people, I think, in this space, is that, again, it varies from state to state. when you go in and do this. So you got 50 different flavors, right,
Yeah.
of how this stuff works. But in general, it's a very, kind of safe way to invest, right? And to that point as well, I don't think people realize is that, hey, mortgage companies, ideally are paying attention to this stuff. And that's why typically you have an escrowed mortgage more often than not. Probably 95% of these things are escrowed to make sure that they're protecting their interest, right? Mm-hmm. So that you even have a couple different layers of security. One, people don't want to lose their house to a relatively small bill in comparison to what probably is on a mortgage. And two, mortgage companies don't want to lose these things or have to go and then, start a bidding war for the property that they just want to foreclose on, right? Mm-hmm. So that way, they're saying, hey, look, it's a lot easier for us just to, pay, $3,000 worth of back taxes and penalties to get that wiped off. So now we retain that superior position in the actual lien stack, if you will. So again, there's a lot of different kind of outs maybe isn't the right word, but a lot of different ways that these things can kind of, and again, there's no guarantee in life, and especially with investing, but, a security factor that, says, hey, you're more than likely going to get paid one way or another. And maybe that's kind of a good thing to go into is that, there's the paying aspect, right? You do this, you buy these liens for a certain rate of return that you're going to be getting, kind of that coupon payment that, there's the benefit that the county's offering you, but let's say they don't pay, right? And it starts going, you're holding on to this thing. How do these things kind of matriculate into then in turn potentially transforming into a deed, right? Not, buying a lien at first and then how those things kind of transition as opposed to just going and buying, those deeds from certain counties.
Well, that's the biggest shift recently due to a Supreme Court case. It used to be there were some states, not many. There was, I think, 7 or 8 states previously where they didn't have the secondary deed auction process. And so those states, you'd buy a lien and then, multiple years later, right, if nobody paid the property taxes, you would essentially just file for a tax deed, right? There was no auction. And the county would go through their process and then issue a tax deed. Well, there was a case that made it all the way to Supreme Court. I think it started in 2017. It took a minute to make its way through, but a couple of years ago, it finally got a ruling. It was heard and got a ruling, and basically the Supreme Court said, what this is a taking, is the clause. Basically what they're saying is, if the person only owed $5,000 in taxes, right? But they had their property taken away from them. There was no just compensation for doing so, right? Nobody really likes eminent domain either, but in eminent domain cases, essentially, right, it's, hey, we need that property that's next to the highway. We're going to pay you, something for that property. And the Supreme Court says that's fair, that's constitutional. They said, this form of tax lien foreclosure was not, and so. They didn't say that tax liens were bad. They didn't say that tax deeds were bad. They basically said this method of not having any mechanism of compensating the previous owner for their loss of equity is not okay. And so those states that had that process that I'm aware of, all but one have changed their process and implemented a tax deed auction. And so this potential of buying a tax lien and owning real estate for the taxes, right, is a dinosaur, is what I'd say at this point. There might be a few of them still hanging out there because they were kind of in that transition, but within the next 2 or 3 years, unless the last state that's kind of hanging on out there is Illinois, and unless if Illinois finally changes their process, then there will not be any option of buying a tax lien and end up owning the property for just the taxes. I think there's a lot of information out there. I can't call it misinformation because it wasn't wrong, right? But the hey, you can own properties for pennies on the dollar just isn't quite accurate anymore with that change.
Yeah, I mean, I think it's, you can control properties for pennies on the dollar, I think is a little bit more of an accurate, phrasing to use for that. And again, that's kind of the, terminology I, hear and, kind of, again, in my capacity, like to use when it comes to, most debt instrument investing is that you have an ability to control something. You don't necessarily have an ability to own and sell it, but you can kind of guide certain aspects of what it is or have a secured interest, right? But again, it's kind of interesting that, for kind of a a market, if you will, that has remained almost unchanged since I've ever known about it. To have something that was kind of a big, paradigm shift occur is interesting. Normally things in the investment world change in, micro amounts here, there, a little bit here, rarely do you get kind of these big like whole like viewpoint shifts like we did with that Supreme Court case. So, and that was how many? It was what, like 5 years ago.
Well, they finally got the official opinion on it in 2022, I believe.
Okay, so
So it's been a couple years since they finally got the ruling. The case itself started, I believe, in 2017. And it took 5 years to make its way all the way up.
yeah, because I remember hearing about it back when I used to be more involved in the actual, client investments and kind of a little bit more hands-on with the investment side of the business. A few of the people that were pretty big in the space would, be like, hey, like here's, some stuff happening. I was like, oh, interesting. Then again, I just kind of never heard about it until now. Again, I assume that maybe some changes had happened, but definitely good to know. So, to transition a little bit, I think we have a good basis of understanding of, at a high level, what these things are and the two different camps of owning tax liens and actual tax deeds and kind of how those work. Now, what I like to kind of help for people to understand is that what are some of like a kind of like the big, and we've alluded to it, right? With the 50 different ways that these things work. What are some of the big pain points that you see for people trying to get involved in this, right? Again, it's great that it's kind of a lower price point in general. Again, the liens are going to be significantly cheaper than going the deed route. But what are some of the big hurdles that people have to get over in order to actually get their foot in the door, right? Because it can be overwhelming to say, like, do I buy in my state? I don't like my state. How do I do this stuff remotely? Like, what are some of those big kind of pain points that people kind of run up against when it comes to, getting involved in these types of investments?
Yeah, it's funny. It's changed massively, and when we pivoted, I didn't tell this part of the story, but after we got introduced to tax liens, I essentially went and raised some friends and family money and started buying tax liens in this 2008 ish. What didn't exist at that point in time was like any source of simple things, right? When these auctions are going to occur, where are they occurring? What are the properties associated with these auctions? And of those properties, right, which ones are worth buying and which ones are not? Because that's probably the number one pitfall is people assume that every property has value, right? And even though in buying a tax lien, it's typically a fraction of the property value, there are some properties where the county might state there's a value, but in reality, how do you get the value out of that? I've seen liens on mailboxes, strips of sidewalk, right? The little strip, the borrow pit between, the interstate type of stuff. And you can enforce those, but at the end of the day, like, how do you extract your value, your investment out of something like that? And so that was I guess giant hurdle number one is just figuring out like, all right, this is something I want to do. Beyond just understanding it is like, now how do I figure out what to buy? In today's world, it's gotten a whole lot easier, but you still have to, depending on the auction, right? We literally will process lists that were advertised in a newspaper, and it's got a name, an amount, and a parcel number, and that's it, right? So how from that do you decide what to buy? And then then it comes down to the logistics of actually buying the right stuff, right? Attending the auction. It is, I'll say, one of the easier industries to get into. It's not regulated. There's no certification. You don't have to get a 4-year degree. You can learn about it and go register for the auction as long as you have a tax ID. And almost every auction in the country, as long as you have that tax ID, you can attend the auction and you can purchase a tax lien or a tax deed. So from that aspect, it's fairly easy, and it's gotten easier with, I say, one of the weird positives of COVID is, prior to COVID, it was really Florida and a couple other jurisdictions that had online auctions, and so it was hard, right, to go. If you can do it locally, that's fairly easy, but if you wanted to go buy tax liens where the rate is higher, right, because the interest rates is higher in some states versus another, you'd have to literally go there in person. One thing that COVID did is it forced, the rest of the country, and now roughly 70% of the country has their auctions online. And so the participation piece of it has gotten a little easier. Now, the downside of it getting easier for everybody is it certainly has increased competition. And so the average rate that people are earning on the tax lien side and the average price that people are paying on the tax deed side is definitely gotten, I'll say harder, in the fact that you don't get quite the same return on the tax liens, and you pay a little bit more for the tax deeds than you did, 5 years ago. Who knows if that'll continue? But right now that certainly is a hurdle, because you're competing with anybody that can invest from their couch, right? And so, it's a double-edged sword with that ease. Those are kind of a couple of the initial things. But once you have a decent grasp of how a state works, right, and you attend an auction and you underwrite properties, actually look at them, and you buy liens like only on properties that have value. You know what you're doing on the deed side. You underwrite properties and purchase them for what you think the asset value is. It's not none of it's easy, right? But it's not rocket science at the end of the day.
Yeah. Yeah, it's one of those things. One thing I like to say, it's like there's a huge difference between, things that are, easy and hard to implement, and things that are hard to implement not necessarily always being worth the value, right? Conceptually, right? Like, how do you lose weight? It's super easy. You eat less than you eat less calories than you burn, and you'll lose weight. Well, obviously, it's hard to implement that, right? Like, conceptually, this stuff is not that hard, but like the implementation of it, again, can be where the rubber meets the road, can be kind of tough, right? And that's one thing I do like about it, is that, things that involve the work on the implementation side, rather than like this big heady, you're an aerospace engineer, right? Things that involve like that much, kind of esoteric knowledge, again, is a big barrier to entry for a lot of people. And there certainly are plenty of financial instruments out there. And I think, some things are complicated for complication's sake, but that's one thing I really like about, this particular market segment. Now, kind of leading into that, to expand a little bit on that, you mentioned something really good, is that, you could have, these really kind of just like obscure places where tax liens are being issued. Like, again, like the, a median or something. There's like stuff that like just doesn't have any intrinsic value for, like, one, who's going to pay it, and two, like, what really is the value? Like, what's the end game, right? Like, do you want to do that and have it go to a deed auction, and then like, why even really do it, right? And it leads into kind of the risk, right? So one, there's the, risk of the understanding and implementation of these kind of concepts, but two, like, there's no such thing as a perfectly safe investment, or at least not one that's worth doing, right? So, where are some of the kind of the risks, and where people can get burned on that, on these things? Like, what are the avenues in which you could lose money in this investment? And again, it's going to be two different things, right? For the deed side is a lot more stuff, but let's start with the tax lien side of the equation.
Yes. And there are, many ways where there's not that many where you lose, right? You can, if you factor in time and cost of capital, right? That definitely becomes a factor. But as far as like losing your principal, never getting it back type of thing, as long as you are underwriting the properties themselves, and the properties have, a decent amount of value, and, typically the liens you're buying are, less than 5% of the value of that property, the advent of losing that principal, a lot can happen to that property, and it's still going to more than cover, what you're into it, right? But people typically, as mentioned before, where you can lose is buying liens on a property that you can't extract that value at any point, right? Like a sidewalk, like a mailbox, because you buy it, the county's not going to stop you, right? The county, they're not doing anything wrong. They're just like, hey, here's all the properties that have open taxes on them. They're not, it's your responsibility as an investor to filter through and decide what has value. And being more creative, I'll just throw this out there, being more creative on how you extract that value, because you can actually end up buying liens that maybe everyone else is avoiding. Everybody is pretty familiar with how to value a single family home, worth $500,000 or more. Okay, that value is going to be there. Not everybody has that same knowledge of how to underwrite an industrial property, for example. And so most people avoid industrial properties, and I would say most beginners should avoid industrial properties. But if you know how to extract the value out of that industrial property, then everyone else avoiding it, you can probably buy it at a better rate, and you earn a better return.
Yeah, absolutely. I mean, kind of the funny, anecdote to that is, investing where people otherwise don't want to operate. The marquee above the University of Miami's business school has a garbage man's name on it, right? The Huizenga School of Business, right? Waste management, like, find what other people don't want to do, and just because it's not attractive to the masses doesn't mean that there's not money to be made in it. But
Right.
again, having some additional due diligence and understanding kind of what that stuff is very important.
Yes.
Yeah.
So that's number one, and then number two, I think, as far as bigger pitfalls people run into is not understanding the actual nuances of each state. Right? I always recommend, before you place any significant money, maybe any money, talk to an attorney in that state that's familiar with the tax sale process, because I've actually seen this happen several times. Florida is one of the most popular tax lien buying states because of volume, because of process, right? They're all online. And in Florida, you have what's called a 5% penalty, meaning you bid this thing. We're getting really in the weeds here, but the way the auction process works is you're bidding down a percentage that you're willing to take on your investment, right? Starts at 18. A lot of it goes down to 0.25%, and most people listening are going, well, why the heck would you buy anything for 0.25%? Well, in Florida, there's what's called a 5% penalty. So even if it redeems the next day, you get that 5% return. And so there's actually, I think there's a book named The Fast Five, where it's, if you target those that are going to redeem quickly, then yeah, you bid it down to 0.25%, but you make your 5% real quick, and on an annual return, it ends up being fantastic. It can be. Now, Arizona's process sounds and mechanically works very different for buying that, but they do not have that 5% penalty. And I've heard many stories of people going to Florida because it's the most popular states to start in. Then they translate to Arizona because a lot of Arizona auctions are online. It's decent volume. They do that. They bid it down to 0.25%, and then at the end of the day, the first thing redeems, and they get their check plus 0.25% annualized return. And like, what the heck's this? Well, they didn't understand that Arizona does not have that penalty, and it's those nuances from one state to the next that can really, at the end of the day, they got their money back, right? But if you equate the amount of time they spent researching the liens, right, and if they borrowed money, like a lot of the institutional investors borrow money, then you're going to owe more than you earn in that scenario, and that's a way that you can get. So those, not understanding the underwriting piece, right, and that you can't just buy any lien, right, and then understanding the nuances of one state to the next are really the two biggest roadblocks between being either frustrated or losing your money, and then at least making something and being happy with your overall process.
Yeah, absolutely. And then let's kind of go into the deed side, right? Because that's where you start to really more money, more problems, right?
Yes.
A saying as old as time. And when you start getting into these things, again, you start getting exposed to everything that's wrong with the property, right? You get exposed to all the deficiencies and things that are out there. So, again, it all kind of comes back to underwriting, understanding what it is that you're essentially, and that, again, that's a very good term to use because you are acquiring debt, at the basis of this, and then how it kind of matriculates up into the deed side of things. Again, like all of that kind of just compounds, right? If someone's not paying their taxes, what kind of other things can be wrong with the property, right? You don't spend millions of dollars on landscaping and not pay your taxes typically.
Right.
I'm sure. Actually, that might be a bad example. There's probably a lot of people that might do that, but what I'm trying to say is that you're not paying a cleaner to come twice a month and then keeping everything pristine and stuff if you're not paying your taxes. Like,
right.
that's can be kind of a canary, the forward facing canary in the very dangerous coal mine, if you will, of the unpaid taxes. There probably going to be an unpaid mortgage. There might be other different types of liens and deficiencies. So
yes.
Are there any things that specifically that you see people kind of fall short on in that arena when it comes to the deed side?
Well, I guess I won't spend a whole lot of time on the asset, your risks, right? Because I think anybody that understands buying real estate, and then knowing that with tax deeds, you at least, I'm almost sure everywhere, I'm not aware of anywhere where you get interior access to the property before the auction. Mm-hmm. You're making a big assumption, right? You get to look at the outside, you can wander around it as long as you have it's vacant, right? But you really don't know what it's going to look like on the inside, and so it's very different compared to buying a house that most people live in off the MLS. You you get, not only do you get access, you get to send an inspector in there, you get 60 days to go get bank financing, you can do all these things. And so your risk of the asset, being degraded on the interior are low with traditional, purchases. With tax deeds, that's the risk that you're taking.
Yep.
And that's why, yes, you can get great discounts, but I know we've funded through our fund properties that look immaculate on the inside, on the outside. You open the door and it's been totally gutted. Like, oh crap, right? So there's risk on that. Now, the hidden risk, or the risk that most people don't think about, you alluded to, is, I'm going to call it title risk, right? You don't get title insurance with these properties. And so many times you're buying a property and it might have errors on the property that maybe they come forward and say, hey, I wasn't notified. And you got to deal with that. Maybe the mortgage wasn't notified correctly. Well, now you got to deal with that. Maybe in a lot of cases, especially in some states like Florida, there's municipal fines. They're not liens, right? So they didn't get wiped out. But you still are responsible for them, and we've found firsthand in Florida, right? Some counties use it as a revenue source. So the $150 a day for not mowing your lawn, and 3 years later, that's a giant fine, right? And you're the lucky winner of the property. Now it's your responsibility. And so those are all from a title perspective, right? Buying tax deeds, not to make it sound like it's don't do it ever, but you got to be aware of it and understand. You're really underwriting tax deeds from two perspectives, the asset value and the title perspective, to really do it intelligently.
Yeah, and this is kind of a good transition point for my story, right? So back in the year, I want to say it was like 2013, it's right when I got started in my career. Had a client that was investing in tax certificates. He lived in a suburb of Atlanta. This story takes place in DeKalb County, one of the abutting counties to the metro Atlanta area. And I had seen the certificates. We've been buying certificates in different counties in Georgia and everything. And normally he would just, say like, hey, like issue me. He used to have to go, for all of their auctions, you had to have a cashier's check. So I'd have to, overnight him a cashier's check. And then we get a return, you pay in a block and then they refund you the amount of money you paid overage, but you had to be cashier's check. And all of a sudden I get a call from the guy and he's like, hey, look, I'm going to need 7 different cashier's checks and different amounts, right? It was like, 3 $10,000 ones, a 50, a 25, and just, it was like $100,000 and maybe $110,000 in cashier's checks. And I had to overnight, early AM ship it to him because he was going to a tax deed auction now. And he was trying to get this property, it was about $110,000, and it would go up, wouldn't sell. And it kept going back and forth. And I think in total, just in fees that I had to charge it between shipping these checks, canceling the checks, it's almost like maybe $4 or $5 grand just in shipping and admin charges just to get this stuff. I think this guy's crazy, right? So eventually he gets the tax deed to the property, wins the auction, gets the tax deed. And come to find out, the reason that it kept selling or they had to pull it from the auctions and stuff is that this thing had, if you can check every box on an issue with like liens and different things with a property, it had it. It had an unresolved easement issue with a utility. It had another easement issue with the county and city. It had mechanics liens. It had basically everything except for a mortgage, right? And I think it also had an unclosed probate. So you have just like, if it had issues in paperwork, this thing had it in spades. So we get the property, and then I continually think this guy is just nuts. So I'm starting to get payment requests for $20,000 to this attorney, $30,000 to this title company, another $20,000 for other stuff to replat because they carved out a portion for the utilities and just got the easement stuff settled. So I think in all we paid, like in total between like what he paid for the property, I think it's about $110 at the auction. Then the $5,000 to us in fees, and then another maybe $60 grand in total of quieting the title. Eventually, he gets a title company in Georgia. It all closes through real estate attorney. So he gets a real estate attorney. Everything's been satisfied. Probate's closed. Easement's done. All this kind of stuff settled, and we get a warranty deed, title insured warranty deed. They issue a real legitimate, nice, clean deed for this thing. A little while goes by. I don't know what he's doing with it. I didn't know if he was going to rent it or not. I didn't hear from him. And then maybe 4 or 5 months later, I get a contract on my desk. He wants to sell the thing. And I look at it, and I think there's a typo on it. And he's listing it for, I think the contract and it was signed by the buyer. He needed us to sign as the seller. It was like $1.1 million on the property, sold in 30 days. I'm just sitting here like this entire time. I think this guy's off his rocker, right? But again, like if you like some of these things, especially on the deed side, like if you have the capital, do it. And there's again stuff that no one wants to touch because I mean, who wants to deal with two different types of easement issues? Unclosed probates; those can be a nightmare. Different mechanics, like everything that's wrong with this property could be. But structurally, it was sound. It was a nice neighborhood. I can't remember what neighborhood in there was, but again, I've seen one of those in almost 15 years. Right, that is that one small speck on that bell curve that hits the other side of that graph, right? It doesn't happen, but I mean, hey, you can't win the lottery unless you buy the ticket. But it was one of those kind of interesting stories that coming out of college and starting to work in finance, especially in alternative finance, I think I see some interesting weird stuff, and that one is, for being so early in my career, still to this day I'm still telling the story. But it was,
Took the cake.
yeah, it was just it's just kind of an interesting example of just how this stuff can work, and that I tell that story for two reasons. One, it's a fun story, right? Who doesn't like hearing about a guy 10xing his money and not having to pay any taxes? I think that's pretty cool. But also just that finding value where other people don't, right? It's like, hey, like this thing had so many issues, and I've seen some of my most successful investors do exactly that kind of general thing of saying, okay, no one else wants to touch this. Like, what's it going to take to get it done? And there's still money to be made. Well, yeah, let's go for it. So again, that was fun story to tell on that aspect. Now, we kind of covered a lot about what these things are. What are some of the issues, how people get involved, and it's still daunting, right? You still have 50 different states, and you have different legislations that go on in all these different places. For example, like he had to have all these cashier's checks in hand at the county to bid on these things. Where I live here in Pinellas County, you can log onto a website. Across the bridge in Hillsborough, you might have to, show up with a check or have a wire same day. Like, they all have the different forms and flavors, which can be daunting. So I know kind of that's what your outfit has tried to aim to alleviate and kind of bring this as a little bit more of a digestible investment right through the tax sale resources platform that you have. So let's kind of transition a little bit and talking about kind of what you're doing in the aspect of like trying to change the market and help people to get a foothold and to be able to invest in these types of assets.
Yeah, it goes back to when I mentioned when we first got in this space, none of those simple things existed, right? As hey, I just want to know when the heck is a taxing sale going to happen and where and which properties, and so that was I'll say big juicy problem number one that initially we were trying to solve, for internal purposes for I'll call it a fund, but it really wasn't. When I later learned like there's some funds out there that invest $100 million plus in this space on an annual basis. It certainly wasn't that level, but we built a simple website to share information back and forth between me and my sister, who still works with me today. And I was suggested to make it open to the public because his idea was, hey, if you open this up, maybe you can cover some of your overhead as you grow. And that's what essentially became Tax Sale Resources, right? I think that the biggest, message I want to get is like we're not a coach or a mentor in the space. There's a lot of companies out there that do that. We have some great information free. It's all just it's a resource center on the website. I interview attorneys in the space, right? But we're not going to be the coach that teaches you. I like to say once you know what what you're doing, then we are all of the tools for you to be successful. We are the where are these auctions happening, what properties are in these auctions, and having the tools in order to sift through all of that, to make the decision on what to buy. And then you can't actually purchase them through the platform, but it's similar to like a Zillow style platform of let's sift through all of this and then determine what is worth buying and what's not.
Yeah, I think that's kind of the big issue, right? Is that the information, right, to underwrite these things effectively. Because, I think probably that big issue that you're kind of solving with that would be, having being able to collect the information in a broad enough scope, right? Kind of what AI does with LLMs, right? Like you need a lot
Right.
of data input to make an informed decision, but it takes a ton of time if you were to go to every single place and try to
Yeah.
scrape that data yourself.
Yeah, I mean, we track 9,000 plus auctions a year. I mean, it's a couple million different properties that end up in that stage. I have a whole team. It's a massive task of trying to compile that. I am not kidding. Where in some areas it is literally we have to subscribe to a local newspaper. That's the only way to get the list, right? So to compile that all into a platform that allows you to do what today is a simple point and click. All right, do I like this property or not? Make that decision. That was very hard, 10 years ago, even 5 years ago. And now it's relatively easy. And that's really what Tax Sale Resources is that tool for anybody that wants to do this at any level to really do it without having to have a whole team to compile that information themselves or trying to do it all themselves, which more power to the guys that want to do that. That's just not what most people don't have time to do that.
Have there been any kind of changing data points that you have seen be really effective for investors over the years, or has always been kind of the same data, it's just collecting it? That's the hard part. But have things changed at all, throughout the, obviously there's some, changes with the Supreme Court case that kind of changes the
Yeah.
tax deed side of things. But with the lien side of things, has there been any kind of like data points that have been either easier to collect or things that you maybe are able to take and kind of aggregate into a new kind of like combined, data point that helps people to navigate this stuff?
I think the main things that most people are using, still using, right, is fairly straight. I mean, I'll call it assessor data, right? What are the parcel boundaries to this property, and what does the county thinks it's worth, right? Those are the biggest pieces of information that everybody needs, because that'll tell you, is it a mailbox or is it the actual property, right? And then is it worth 10 grand or is it worth 300 grand, right? Those things tell you a lot from a lien standpoint. Now, as it's gotten more competitive, yes, there are more and more data points that folks have rolled in to try and get that edge, right? Environmental data, right? They want to go after commercial and industrial, but they want to know when there's environmental problems, and so they'll add that in, right? So they kind of have that answer. Flood information, right? Those are data fields, because they it's oddly enough, I think it was Colorado where one of the investors got hammered, buying a bunch of properties. Don't think of floods in Colorado, and then a lot of the properties, got flooded, and obviously that degrades the value massively when that type of thing happens. And so there's different, I'd say, niches of data that's been rolled in, but for the vast majority of liens that are purchased, it's still the basic, what is this property and what's its value, and then the rest of the information that's been added on to that has been, I'll say, gravy, right? Or enabling people from a niche standpoint, right? Pictures of the property, today versus what Google said it was 3 years ago. I mean, it's gotten easier to do these things, but it hasn't necessarily changed, the industry massively to where you can't underwrite the same way you did 10 years ago. You just do it a little easier.
Yeah, I think that's a pretty interesting point, especially about environmental data, and that's especially clear right where I'm talking to you from right now. In Pinellas County, we're having, we just had, a new FEMA map drawn for our area, which, changed a lot of floodplains, but also just the massive amount of damage from flooding we had from Helene. We're
Mm-hmm.
seeing a ton of properties. I would imagine that, again, this is kind of the perspective of with some of the FEMA damage rules for how things work in our state, is that, over, they deem a significant, a structurally significant amount of damage requiring either raising of a house or demolition of a house, raising, like physically raising, which is really fun to watch when they like stick pilings up and just raise the whole darn house up. So I saw a
About 6 feet off the ground, right?
yeah, I saw a news article the other day. A guy forgot to take his car out of the garage before they lifted it.
Whoops.
I thought that was pretty. I mean, I don't know if that's true or not. It might have been just someone making something up. But if it did happen, pretty funny.
Yeah.
And again, that might lead into, people again, if let's say someone's lived there since the 70s and they don't have a mortgage, but they also are fixed income and then they can't afford things like this, it's going to kind of lead into, them having to pay for other things or not paying taxes. And then how does that affect like the quality of that debt? If it's something, again, there's a lot of things where I think the environmental aspect is a pretty interesting data point that, a few years ago, I really wouldn't have thought too much on it, especially in the tax certificate space, tax lien space. It's not something I would have thought about, but that's pretty interesting that, that is kind of starting to come in. And especially for the perspective that you said, Colorado was one of the ones that kind of highlighted the need for that. You wouldn't think, Colorado being, you think, tornadoes and blizzards. I wouldn't think flooding.
Yeah, exactly.
But I mean, hey, the Colorado River did create the Grand Canyon, so they do.
Yeah. There's some water that comes out there. Yeah.
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 And so, go ahead.
No, yeah, it's just it's I think a different way of looking at it with all these different underwriting points, right? Or investors they look at it from, I'll say, the right perspective is it's more about loss mitigation as opposed to maximizing your upside is one way to look at it. With tax liens, that's hard. There's only so much you can do. There's a lot that you can do in minimizing your downside, right? And so all of those are like, hey, it's a very small percentage that are going to be flooded. But if you can eliminate that, right, if you're doing this at scale and investing, a lot of money, then that goes straight to the bottom line for them. And so, and I'm saying that because I think most folks that are just getting started in this space probably don't need to worry about it from that perspective as much because they're not going to deal with those sorts of problems. But as you grow, then you start to need to care about some of those things.
Yeah, absolutely. And, it's location dependent too. If you're just investing in Pinellas County, it's a lot more of a viewpoint than if you're investing up in Leon County, where I grew up in North Florida, right? It's, again, it's just, again, I think that's really a good resource that people can, lean on, especially if they're trying to get into the space of understanding, what the pitfalls are. Because that's, probably where you need to start with a lot of investments. Understand the pitfalls, then understand the return profile, and then make a decision. I think people kind of, work backwards from that too often than not. And that's one thing I try to do on this podcast is say like, hey, like, let's look at, it's like, if this whole thing goes belly up and is, floating down the river, like, well, like, let's figure out what happens there. And then, okay, let's say like what happens in best case scenario, right? Like, understanding where those risks are is probably a good thing to start with. Now, again, we kind of covered a lot of how, there's a lot to do with this, right? Between tax deeds, tax certificates, different risks, different way that these things pay out with like that 5% penalty. You talked about that, gets automatically paid in Florida, whereas you have a very similar kind of profile in Arizona, but you don't have that. So you could only maybe get 1/4% on something that redeems very quickly.
Right.
So I'd imagine that's kind of maybe one of the things that led you into, understanding this market so well and then creating a fund as well, right, around these kind of assets as well to allow people to get exposed to the, return and security profile of this while not having to, figure it out and kind of boots on the ground as well. So maybe we'll talk about that other aspects. That's probably kind of that natural growth cycle, right? You started as the investor, then you start aggregating data, and then you're like, hey, like I'm good enough at this. Let's, bring this into where we can package this together for investors to come in and invest alongside us.
Yeah. I was, I guess I gave up on the whole direct buying in 2012 because the software data side took off. And then also a lot of our clients, I didn't want to be perceived as competing with them. And so we gave up the whole tax lien buying methodology in 2012 and really had never really had any intent of getting back into it. What we did know is there are several lenders that are lending to tax lien buyers, but there were no banks, there's no institutional lending on the tax deed side of the house. And so we I guess being an engineer and liking to solve problems, set about trying to convince a bank in the late, this is 2017, 2018, trying to convince a bank to be a lender in the tax deed space, right? And that's where we learned a lot of why they don't, right? And well, you can't get title insurance. Well, we were pretty successful convincing a bank that was already lending in tax liens, at least they understood the space to some degree. We provided a whole lot of data, right? And eventually got them comfortable with, underwriting tax deeds from their perspective wasn't a whole lot different. But they got them on board with the concept of, hey, we know we could get more, our thought process, we get more users on our platform if we could solve their biggest problem, which, for the tax deeds guys, it was access to capital. So we basically got, I'll say, 3 inches from the finish line with a bank. And they, my understanding is the only thing they were waiting for is basically direction from the SEC on where to put these assets, right? Do they go in a real estate security bucket or real estate, right? And at the 11th hour, my understanding is the bank got a letter back from SEC refusing to tell them exactly where to put it. Not like, hey, we won't tell you. It was like, no, we don't, we're not going to tell you type of thing. Now the bank, and I don't know if it's true, but the bank basically took that as it doesn't matter where we put it. We're probably going to be fined at some point down the road. And so we love the idea, but we're out. And that was, frustrating, right? A door being slammed in our face, because we figured if we couldn't get them across the finish line, it wasn't going to happen. I'm also a believer of, when one door closes, maybe another window were to open. And we basically sat down and said, you know what, right? We got the guys at the bank on board with this concept. They're afraid of regulation. That was their only, fear. And so what if we basically started a fund where we could enable the tax deed buyers like we had planned, right, and work with them as a capital partner, is the way it's structured. We're not a lender. And then on the flip side, maybe there's a section of our customers that, or we knew, right, they came in the door, did some research, and then realized, you know what, this is a lot of work. I like the space, but I don't necessarily want to do all of the work myself. And what if we somehow married those two with a fund in the middle that would help manage that process? And so that's really how Mountain Earth Capital came to be in 2020. Perfect timing with COVID, right? But we went about doing a proof of concept with Fund One. Essentially placed $1.5 million, doing this model, and really focusing on finding tax deed buyers locally that were cash limited. We would partner with them where we go and buy the properties on their behalf, right? And then we work together in selling those properties. And we did that successfully. And then Fund Two, we went and raised $5 million in capital as like a proof of scale. All right, we have this concept. Can we actually scale it at all? Did that successfully. And then in that process, had a group come forward and say, you know what, we really are excited about doing this as a private equity group. We would love to be kind of your primary investor in the space, and opened up a line or an investment of $35 million. And so we spent the last 2 years growing the fund from $5 million to currently at $38 million, doing exactly that, right? Where we are placing capital for the investors that, place their capital with us, right? We pay them a quarterly dividend. And then on the flip side, we work with local folks on the ground that do want to do the work and be their capital partner where they're typically capital limited. And so we've solved that problem, right? Not everywhere. There's a lot of room for growth. We're a long ways from our data ever capping out or maxing out what we think we could place in the space. But we're well on our way of being kind of the sought-to source of capital for tax deed investors out there. And that's, long story short, a Mountain Earth Capital in a nutshell.
Yeah, it's always interesting to kind of hear how these things kind of come into play, especially with people that operate in kind of a vacuous space, right? It's like there's really no one there. Then you come in to fill the void. It's like, well, what does that look like, right? And having issues with banks, like, again, I've seen more issues with banks and different things than I'd ever cared to talk about on a podcast, especially being in finance. But I can definitely see where that kind of came to be a trouble point. And then just finding, again, to the point of whose name's above the business school at Miami. Again, like finding something that other people aren't doing and doing it better than anyone else. Well, again, if there's no one else to do it, you're fighting against yourself for that title. But again, it's really kind of interesting to see just how that that need for that space really was never filled by anyone in the past, right? It's like there's people, when I see people kind of making money at the underlying investment, and I don't see like a commensurate like capital flow behind it from institutional. Is not the greatest word to use. What you're doing is not institutional level, but just at all, right? Just kind of the consolidated like capital flow of past just people kind of individually lending on these, or people the individual point person to person kind of aspect of it. So very cool that was something y'all were able to do, and especially getting through COVID, which was I'm assuming probably was like something that was really tough to look at from the initial perspective, but probably wasn't too bad. I mean, real estate just really took off during that time.
Yeah, I think it was. Well, I mean, at the beginning of it, right, everybody was, the smart people got rid of their real estate right at the beginning because real estate was going to tank. I think that was and then the really smart people that got rid of it 6 months later, we're kind of going, oh crap, right? Because values just skyrocketed. And I think if we were operating the $150-200 million fund that we think we can eventually get to at that time, it probably would have been a big hit because there were a lot of cancellations of sales. We were very early in the process, right? There was more than enough product out there for us to work through, and placing, roughly $5 to $7 million and throughout COVID, and so it worked out well, right? We didn't time it well, or we didn't time it. We had no control over that, but still worked out well for us.
Awesome. Well, great. I really appreciate you being on with us today. It's always good to have people, be able to talk very, specifically and intelligently against something that, just really doesn't get a whole lot of press except for, some of the voices out there just like, do this, do this, do this. Kind of dig into it on a more granular level is something I personally enjoy. I love the detail aspect of this these kind of things. So again, really appreciate you being on with us today. If people are interested in reaching out and learning more on the data side or what you have on the investment side, what are the best places to reach out to you?
If you go to taxsaleresources.com, you can poke around there, or there's a phone number. Call, and there's actually a real person that answers the phone on our end, and there are real business hours, so you can't call at midnight type of thing. But if you call during normal business hours, there'll be somebody and to say, hey, I saw Brian on Alex's podcast. I'd like to talk to him about, X, and they'll get you in touch with me.
Awesome. Fantastic. Well, Brian, really appreciate you being on with us today. The most valuable resource we all have is our time. No matter how well we invest our money, can't make any more time. So again, appreciate you taking a few moments out of your day to chat with us. Again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we will see you in the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.